Thank you, Sandile. Thanks for setting the scene. Thanks to all of you for joining us and obviously for your continued support. I thought that a good topic for this morning's presentation would be to discuss one of the characteristics of the free market, and that is capital, as if guided by some invisible hand, will always seek out the highest risk-adjusted return. However, rather than starting off the discussion with financial capital, I thought we should start the discussion off with human capital. So this is actually a picture of a Syrian refugee making land in Greece. The last part of this journey most often done in nothing other than a rubber dinghy. And you can just imagine how difficult the situation is in Syria if an individual is willing to take on so much risk in search of better returns for their children or a better future for their children. Now, human capital will seek the highest returns even if there isn't significant turmoil at home. And we've seen that actually in South Africa. In the last 20 years or so, numbers are hard to come by, but an estimated 750,000 individuals have effectively left South Africa, predominantly for other English-speaking countries like the UK, Australia, and the US. Those countries offer better employment opportunities, but also less concern around crime, healthcare, and education. Just before, however, you think that this is going to be one of those presentations where we just constantly knock South Africa, the homecoming revolution also tells us that in the reverse, about 350,000 individuals have returned back to South Africa. A large number of these individuals have returned post the global financial crisis in 2008, where developed market economies also contracted and shed large numbers of jobs. Okay, however, as I've now probably exhausted my knowledge of human migration patterns, the rest of the presentation is really going to focus on financial capital. And there are really at a simplistic level, three major players within this financial capital value chain. There's your SA corporates who are effectively capital hungry. They require capital to grow, to invest in new projects, and to create jobs. Then there's ourselves as effectively a financial intermediary in this chain, really just linking your borrowers and your savers. And then ultimately, there's yourselves and your clients who are effectively the source of surplus saving in the economy. The majority of the presentation is really going to focus on how this characteristic of capital seeking the highest return has changed the capital allocation decision of corporate South Africa, and how this has fundamentally changed the composition of the JSE, effectively the equities that you buy. And I'll also spend some time as how we at Prudential allocate the capital that you have entrusted in us in order to seek a higher return. Okay, this is actually my favorite slide of the presentation. We put this together with RMB Morgan Stanley. Every dot represents a distinct acquisition by a South African corporate since the end of apartheid in 1994. Okay, there's effectively 165 dots that will animate on this slide. It's effectively a huge capital investment by South African corporates in the rest of the world. And in fact, we've actually excluded some of those companies like Anglo-American SAB, which in the early 90s had already domiciled themselves in the UK. Now, there's a number of reasons for SA corporates moving offshore. Initially, it was really a bona fide move to diversify their profits and their revenue away from South Africa following years of isolation during the apartheid regime. More recently, the expansion has really been driven by a collapse in South Africans' growth expectations relative to the rest of the world. Back in 2007, our guest speaker Trevor Manuel, when presenting his budget, talked about the fact that then the economy was creating 500,000 jobs and growing at a rapid pace, around 5%. But since then, our economic transformation has been undone by a combination of the global financial crisis of 2008, the decline in the commodity supercycle, and frankly, an inordinate amount of own goals by the current administration. Now, expansions obviously involve risk, and South Africa's had their fair share of South African corporates have had their fair share of disasters. Some of the feedback from the Johannesburg presentation was that perhaps we were focusing too much on the negatives and all the sort of corporate disasters that I'll touch on now. But I think it's important to highlight that if there is indeed one criticism of SA corporates, is that they've often suffered from the syndrome that the grass must always be greener on the other side of the fence. And in search of higher returns, they've often underestimated or underpriced risk. So a classic example is Old Mutual, a company I know pretty well. They, since demutualizing 1999, had this desire to diversify away from the rand. But effectively, in trying to get away from currency risk, they took on too much market risk. So in 2001, at the peak of the dot-com bull market in the US, they effectively overpaid for a US asset manager. 2006, 2007, they underpriced financial guarantees in Bermuda, and that ultimately nearly sunk the group. Netcare, a South African hospital group, obviously faces a large amount of regulatory risk in South Africa. They sought to diversify this by buying a business in the UK, but then took on too much financial risk. So effectively all they've done is swapped regulatory risk for financial risk, and it's unclear now, 10 years into this merger, if that really added any value for their shareholders. Okay, Nigeria, an interesting country. MTN had some tremendous and early success in Nigeria, and given the latent potential of Nigeria, combined with the sizable population, this country has attracted a number of SA corporates to its shores. Unfortunately, MTN and its success in Nigeria was actually the exception rather than the rule, and a number of SA corporates have stumbled in Nigeria. The largest failure was actually Telkom's acquisition of Multilinks, where I think they had to write off an 8 billion rand investment. On the eastern side of the continent, Altec effectively had to pay another company to take their East African operation off their hand. Both these companies effectively underestimated the risk of being pioneers on the African continent, and also took on a significant amount of technological risk in their acquisitions. Lastly, Exxaro, a coal company that supplies coal to Eskom, thought it was a good idea to increase their exposure to iron ore at the peak of the commodity cycle in 2009, this time in the DRC, clearly taking on too much commodity price risk and country risk. So I guess the conclusion here is, yes, it's difficult to do business in South Africa, but it's equally difficult or more competitive elsewhere. Okay, let's talk about the successes. So there's been huge successes of SA corporates diversifying. SAB Miller and Naspers are probably the two best examples of companies that have become truly global in nature, and this has fundamentally changed the composition of the JSE. So what this chart shows is for the top 40, the largest top 40 companies on the JSE, what proportion of their revenue is generated from offshore. Okay, so in 2000, that was about a third of the revenue came from offshore, and that has grown over time to around a half. And bear in mind, for this side, we've actually kept the rand constant at the 2000 level of 7 rand to the dollar, just to show you just the impact without currency movements of this diversification strategy. Okay, there is a bit of a decline from 2011, but that's largely a result of the decline in commodity prices. So the way we've constructed the slide is if you've got a platinum company and they're selling their material into Japan, that is regarded as offshore revenue, and obviously as the platinum price and other commodity prices have declined, so has the composition of offshore revenue. The rand has been quite weak since 2004, and that is also another reason for this continual offshore expansion by SA corporates seeking to bolster their income statement with some kind of hard currency earnings. And that has had a dramatic impact on the revenue composition. So the yellow bars effectively show the offshore revenue component at each time using the current or the spot exchange rate at each point in time. And that has shown you effectively that from about 1/3 of the top 40's revenue has been generated offshore, that has grown now to around 2/3. Okay, some of you may remember this. This was the 1994 logo for the JSE. Basically buy a share and own a share of South Africa's future. Okay, but effectively what the previous slide shows is actually investing in the JSE is not necessarily about owning a share of South Africa's future any longer. Excuse me. In fact, if there's one characteristic which differentiates the South African market from other emerging markets, it's the proportion of revenue or earnings that is actually generated from offshore. So the JSE is actually a very poor barometer of what the market thinks of South Africa. So in the days following Mr. Nene's dismissal, the SWIX index, the shareholder-weighted JSE index, fell only about around 5%. It was a loss of market capitalization of about 260 billion rand. But we actually estimate that if the market had the same composition as it did in 2000, that decline would have been twice as large, or about 10%, 600 billion loss in market capitalization. So if you really want to know what the market is thinking about South Africa, you really need to look at the CDS spreads that Sandile talked about, or the 10-year bond yield, or the rand. The JSE is actually a very bad barometer, and perversely enough, if there's bad news in South Africa, you may actually see the JSE making all-time highs. So in fact, the JSE is about 5% off its all-time highs, even as we walk into the rating decision on Friday, whereas bonds, as Zandile alluded to earlier, are effectively now beginning to peak. Okay, sticking with the JSE, last October, one of the political parties marched on the JSE, and in their memorandum argued that all companies and corporations that have the majority of their business in South Africa should also be listed here and have their head offices here. The irony is that our work suggests that if you define the majority of business by revenue, the majority of revenue is actually already offshore, and it's telling now how many CEOs of JSE listed companies have also now effectively placed themselves offshore. Okay, so in summary, for this part of the presentation, if 100 Rand is generated on the JSE, and here we've used the Swix index, only 43 Rand is actually generated within South Africa, and the rest of the revenue is really spread across the rest of the globe, as illustrated on the slide. China, incidentally, is actually the second largest revenue contributor to the JSE. More recently, that is actually a result of Naspers' investment in the Chinese internet giant Tencent, and then obviously the fact that a lot of South African mining companies still sell their product into China. Okay, moving on to the financial intermediaries and Prudential. How do we seek the highest return for your capital? Central to this is obviously our equity investment process, which I'll run you through in a couple of slides, using, where possible, a number of examples to illustrate some of the points we're trying to make. Okay, so this is the equity investment process that we often show. Step one is a value assessment. There's numerous ways we can conduct a value assessment on our investable universe, but seeing that we're talking about offshore expansion, effectively what I'll talk about here is how we at Prudential evaluate the strategies of different firms, and then try and pick between those two different firms. Okay, the second step is effectively understanding the fundamentals, and included in that is what we often talk about is the use of long-run valuation anchors of where assets should be priced. Again, using the example of our finance minister, not Desmond van Rooyen, who only had 4 days in office and really didn't say much. But again, Trevor Manuel famously said once that he insists not to be stampeded into a panic decision by some amorphous entity called the market. And we tend to agree, and we believe that our use of long-run valuation anchors helps us not to be stampeded into a panic decision. Peter Hugo later will show you one of the valuation anchors that we use for the Rand, and I hope that my example on Shoprite will be equally illuminating. Okay, and then I'll finish off with some quick comments around portfolio construction, because obviously what we're trying to do for you is not just get you the highest returns, but also try and manage risk versus some kind of benchmark or peer group. Okay, so let's start with the first stage, which is the value assessment. I thought I would take 2 food companies, Tiger Brands and AVI. They effectively own and market a number of enviable brands. So AVI is your Zoo biscuit manufacturer. Tiger Brands effectively is your All Gold manufacturer. And we start this comparison in 2008. At that time, Tiger Brands had just unbundled their stake in Adcock, one of the pharmaceutical companies, and had effectively become a pure play food company. And incidentally, it also bid for AVI in November of 2008. They had bid about 8 billion Rand to try and acquire AVI. Ultimately, AVI was able to rebuff that corporate bid. Now, these companies are selling similar products to a similar target market, so you would expect that their profitability or their earnings would grow in line. And that's in fact what we see from 2008 till about the end of 2010. Okay, but then if we fast forward, we see quite a divergence in the profitability of these two companies. So Tiger Brands earnings, in fact, do very little, whereas AVI over time compounds their earnings at about 15% per annum, growing from about 100 to about 300 over time. And we would argue that a large part of this divergent earnings is actually the result of a divergent strategy. So AVI really sought to invest locally, improve its local manufacturing, roll out more fashion stores for their fashion operations, and conduct one or two small acquisitions. Tiger Brands, on the other hand, having lost out on an 8 billion rand bid for AVI, spent a similar quantum on acquisitions, both in South Africa, the rest of the African continent, and as far away as places like Chile. Okay, but it was really the African expansion plans which got them into trouble. This started in 2011 with 2 acquisitions in Nigeria, but the big acquisition was in 2012 when they acquired Dangote flour mills from the richest man on the continent, Mr. Dangote, for about 1.5 billion rand. Business was also highly leveraged. They took on an additional 1.5 billion rand of debt with that acquisition. Now, the original rationale around that acquisition was that it would add scale to some of the other operations which Tiger Brands had bought and effectively cement their African expansion strategy. There was quite a lot of hype around in 2012 around companies that had a very good African growth strategy. Unfortunately, things didn't turn out that well for the Dangote flour mills business, and at some point Tiger Brands was actually forced to inject a further 600 million rand into that business to effectively keep it alive. As things have transpired, they've actually been forced to sell that business. In fact, they sold it back to Mr. Dangote for the pricely sum of $1. Okay, so about 3.5 billion rand in, and we get about 1 billion rand out. The animation that we try and show here is if we try and reverse the operating losses that Dangote has incurred for Tiger Brands and add that back to Tiger Brands' earnings to see what the earnings would have looked like without that acquisition. And then the second animation says, well, rather than investing 1.5 billion rand of equity into Dangote, if we had invested that in another project and that had just earned the cost of capital, what would have been the earnings of Tiger Brands? So you can see the differential between those two red lines. We would argue effectively that is the value destruction of a failed acquisition strategy. And it's no surprise that the CEO and more recently the CFO of Tiger Brands have effectively been replaced. The remaining gap between AVI and Tiger Brands talks to obviously good capital allocation decisions at AVI and also the fact that Tiger Brands face quite a lot of competition in some of their domestic categories as well. Now, over time, you would expect share prices to follow profitability and earnings. So again, no surprise that AVI has outperformed Tiger Brands quite materially. Initially, we were shareholders of Tiger Brands in late 2008, early 2009, although we weren't that enthused by its bid for AVI. We were even less enthused about its African growth strategy, and therefore while it was spending money acquiring businesses in Africa, we were spending our clients' money building quite a sizable stake in AVI. We were overweight the stock from the end of 2011 all the way through 2015 and exited our remaining stake earlier this year. Tiger Brands, however, did get quite interesting, particularly around the very negative news flow when they had to ultimately exit Dangote, and that presented a buying opportunity for the funds. At that point, our view was that Tiger Brands was looking quite attractive. Having put Dangote behind them, our view was that they would now begin to grow their profits at a similar pace to AVI, as was the case between 2008 and 2010, but the market was penalizing them for past mistakes, and we were able to effectively buy Tiger Brands on a P of 15 when AVI was trading on a P of 18. So the value differential was quite attractive for us. Okay, moving on to understanding the fundamentals of a company and our use of long-run valuation anchors. This slide simply shows Shoprite's EV to EBITDA over time. EBITDA is really just a fancy acronym for earnings before interest and tax. So what is the market willing to pay for the profits or the cash flows coming into the business? So historically, the market quite happy to pay about 8 to 10 times for the annual earnings of Shoprite. But then as we enter 2011, 2012, we see quite a steep valuation increase in what the market is willing to pay for Shoprite. At some point getting up to sort of 20 times. Incidentally, over time, the average, what Shoprite tends to trade at is about 11 times EV/EBITDA, and that's what we would argue is effectively a valuation anchor. gives us as portfolio managers an indication of where that asset should be priced over the long term. Okay, obviously things aren't always that easy because companies change and fundamentals change, and also when prices are rising that rapidly, there's always going to be an analyst, a journalist, or another investor arguing why these ratings are actually sustainable. Okay, but in retrospect, we would argue that a lot of this was actually noise. So in 2012, the noise was around the premium that we should be paying for companies that are going offshore, particularly into Africa, seeking higher growth, the likes of your Tiger Brands and your ShopRites. And that's not to say that the African growth story doesn't exist. It does exist, but the risk lies in analysts extrapolating current growth rates into the future, and the future is always uncertain, to try to justify a very high share price. And effectively at the peak of the ShopRite share price, we had one investment bank arguing that the ShopRite share price was justified because the African operations were going to grow at a compound annual growth rate of 20% in US dollars till 2030. Now, I don't need to tell you as financial advisors what the power of compounding at 20% in US dollar terms for 18 years actually translates into. In fact, we've looked at the S&P, and very few US companies have actually ever been able to grow at this rate. Only a handful of companies, one or two biotech companies, and obviously Apple. In fact, so incorrect was this forecast that it now looks like that by 2030, the whole of ShopRite, being the South African and the African operations, will not reach the dollar revenue target that they thought just the African portion of ShopRite would achieve. And that's often why you'll hear us saying, and I think Peter will reinforce it a bit later, we don't try to overly rely on forecast. We'd rather try to work out or ascertain what the market is pricing a particular asset at. So what was the market pricing ShopRite at, or the African operations of ShopRite? What we've done here is we've taken the annual profits of ShopRite South Africa, and multiplied by that valuation anchor of 11 times, and then said, okay, what was the share price shown in red here of ShopRite? Okay, so if that's the value of the South African operations and that's the share price, the difference must be what the market is implying the African operations are worth. We can then compare that value to the annual profits of the African operations, and then we get this dotted line which we can read off the right-hand axis. Okay, so the market was paying around 10 to 20 times for the profits of the African operation. That's not too unrealistic, given that we argue 11 times is a good valuation anchor for the SA business. Okay, but as we entered 2011, 2012, those multiples actually got unrealistic, and you were paying in excess of 50 times the annual profits for those African operations. Okay, so we all know how the story ends. ShopRite share price gets quite expensive. Lots of people are buying it at the peak, but effectively what we see is actually a derating and underperformance of ShopRite. Thankfully, we were not panicked into a decision here. We never held ShopRite, and we've now seen the stock actually find enough return to its valuation anchor. We would actually argue now that ShopRite is beginning to look quite attractive, although it still hasn't found its way into our funds just yet. Okay, just two more slides from me, ending off with portfolio construction. This is often how we represent our portfolios to clients, showing them how we are positioned in red, relative to, in this case, the general equity universe. So underweight financials, overweight consumer services, etc. But given that our talk has talked quite a lot about the offshore versus the local component of revenue, what is also instructive to look at is, are you overweight the domestic portion of the JSE or the offshore component of the JSE? So basic materials is an interesting segment of the market to look at. We're underweight, but we're actually more underweight the local portion of the basic material stocks. So stocks like ArcelorMittal or Exxaro, which are producing product that is being sold back into South Africa, we're actually more underweight those counters, because our view is GDP growth is very limited, and as a result, we believe those companies will struggle to actually pass on price increases. We're slightly less underweight those global diversified miners, like, let's say, BHP Billiton, which is selling its product into the globe. Okay, then ending off with yourselves and as IFAs, obviously also looking to maximize returns for your clients. We thought the following slide was instructive. This is a 10-year history of those funds with a 10-year track record in the domestic general equity sector. and that's effectively how the Prudential funds have performed versus both the average unit trust manager and the market. And with that, I think I'll hand over to Peter, who will wrap up the Prudential range of speakers. Thank you.